Most traders will check Fibonacci levels to trade, but do you know how to differentiate your butterfly from your bat? These Fibonacci patterns will often signal a reversal in trend. Hi, my name's Ian Coleman and I'm a senior analyst at FXStreet. In the last video, we covered Fibonacci trading with market structure. In this final video in the Fibo series, we dive deeper into Fibonacci trading, covering Cypher patterns, consolidation and expansion, entry levels, invalidation, liquidity sweeps, and combining formations. Sounds confusing? Stay with us. Where do I enter Fibonacci trades? We know that markets move from balance or consolidation to imbalance or trending. Although the big money is to be made when we break out of consolidation, it is also possible to trigger trades within the complicated sideways phase. For this, we use Fibonacci confluence zones. The meaning of the word confluence is a place where things merge or flow together, the process of convergence. The patterns we can find through Fibonacci confluence areas are known as symmetrical or Cypher patterns. The inside patterns used during periods of consolidation are known as the bat and the Gartley. The outside patterns are known as the butterfly and the crab formation, and they are seen after a breakout. We will look at the inside patterns first. Institutions look to buy at a discount and sell at a premium. Discount is close to the lows, premium is close to the highs. Many traders will consider the middle of the range as just noise. However, this is known as an equilibrium zone or fair value, and it will often attract new institutional orders. There is a myth around perfect entries. Although they are sometimes hit, more often than not, institutions will look at a zone. Fibonacci confluence areas give you that zone. For inside Cypher pattern analysis, we need to use different Fibonacci levels than the standard. The Fibonacci retracement levels are 38.2%, 50%, 61.8%, 78.6%, and finally 88.6%. When we see a confluence of these levels, it will often result in a reversal in price action. The Gartley is the most common Fibonacci retracement pattern. The corrective legs should be seen in three waves. This is annotated as ABCD. AB should be a 61.8% Fibonacci retracement of the last major move. The BC leg and the completion of the Cypher pattern should be close to the 78.6% Fibonacci level. The invalidation of this Fibonacci trading setup is a move through the start of the formation at X. The bat pattern is seen when the first wave stalls at the 38.2% or close to the 50% pullback. This is leg AB. The completion of the Cypher pattern is close to the start of the formation at the 88.6% Fibonacci retracement. Although this is a rare pattern, with the invalidation of the Fibonacci trading setup being close to the start of the formation at X, this offers a very tight stop loss policy. Worth the risk? An impulsive breakout from a balanced market will often be short-lived, stalling and reversing when it hits a Fibonacci confluence zone. For outside Cypher pattern analysis, we need to use different Fibonacci levels. The Fibonacci retracement level is 78.6%. The Fibonacci extension levels are 127.2%, 161.8%, and 224%. When we see a confluence of these levels, we will often see a reversal in price action. This is selling at a premium near the high or buying at a discount near the low. The butterfly formation is the most common of the outside patterns, and this will often be associated with a liquidity grab. AB should be a 78.6% Fibonacci retracement of the last major move. The BC leg and the completion of the Cypher formation should be close to a 161.8% extension of the AB leg and a 127.2% extension of leg AX. This is a confluence zone. The crab formation is seen as an extended cipher pattern. The BC leg should be close to the 224% extension of AB and a 161.8% extension of AX, another confluence zone. Unlike the inside patterns, outside formations do not offer a natural invalidation level. I look to place my stop loss outside obvious areas of liquidity, or in the case of the crab formation, above the 261.8% Fibonacci extension. Where do I enter Fibonacci trades? We have various entry models. Note, we are not trying to guess the building of the formation, we are trading the completion. This is a textbook rule. We have discussed various entry models. This is the 261.8% extension or exhaustion level and the inside and outside cipher patterns. It should be noted that commodities and commodity-based currencies can extend past 261.8% up towards 361.8% and even 423.6%. So what about the dreaded liquidity sweep? We have covered this subject in previous videos, but it's worth a reminder. We will often get periods of accumulation or distribution before a 261.8% Fibonacci extension level. This is institutions or smart money players building short or long positions. This leads to a spike out of the consolidation to complete the 261.8% Fibonacci, catching liquidity, which is often retail stop losses above the previous swing high or previous swing low, and then it reverses in direction. We know about top-down analysis, looking at higher time frames to analyze shorter time frame moves. What we haven't discussed is formations within formations. In this example, we're going to look at the euro against sterling. The daily chart shows the completion of a bullish bat formation at 0.8626. The 1 hour chart shows the completion of a bullish butterfly formation at 0.8627. This is confluence upon confluence. Let's summarize what we've learned. Fibonacci trading is mainly repetition. The same patterns are repeating over and over in life and in trading. Keep it simple. When starting, use the core levels. Trade Fibonacci extension levels with market structure. Trade retracement levels with cipher patterns. Remember, markets consolidate between 60 to 70% of the time. Look at the bigger picture for a bias. Don't be a liquidity giver. Don't outstay your welcome. Patterns inside patterns add weight to the analysis. And lastly, just keep evolving as a trader. There is always something new to learn. We really hope you've enjoyed this series on Fibonacci trading. Do you have a subject where you would like us to take a deep dive? Let us know in the comments below.